Our goal for you today is very simple. We want to make every single concept from this module stick in your brain permanently.
Yeah, no jargon left unexplained.
And no formula left behind. It is going to be an exhaustive, ultra-detailed exploration, and you're going to conquer it together.
That is exactly right. And as we dig into these mechanics, I really want to emphasize one crucial point for you right at the top.
Okay, lay it on us.
While the math is undeniably important, and, we will get into the weeds of it today,
Oh, we definitely will.
understanding the why behind these formulas is what separates rote memorization from true financial mastery.
I couldn't agree more.
We aren't just going to plug cold numbers into calculators today. We are going to look at the underlying economic reality, the human behavior, and the market psychology that those numbers actually represent.
Because if you just memorize formulas, you're going to freeze when a question twists the premise even slightly.
Exactly. If you understand the underlying logic, you'll be bulletproof.
Okay, let's unpack this. I love that philosophy. And as you say that, I see your backdrop has completely shifted for today's session.
I thought we needed the right vibe.
It's perfect.
Yeah.
For those of you following along, we are now looking at a classic mahogany paneled library. There are heavy, leather-bound financial tomes lining the shelves. The lighting is very moody and academic.
Very serious.
Very serious. And right in the center, there's a glowing chalkboard just waiting for us to diagram some of these concepts.
It is the perfect aesthetic for what we are about to do.
It really is.
Yeah.
So let's start with the absolute bedrock of finance. Interest rates. I feel like we hear about interest rates every single day on the news.
Constantly.
But if you actually ask someone to define what an interest rate is, fundamentally, they stumble.
They absolutely do. And it all begins with a foundational concept known as the time value of money.
Okay.
This is the core principle that establishes the equivalence between cash flows occurring on entirely different dates.
Right.
Simply put, human beings are wired for immediate gratification. Cash received today is intrinsically preferred to that exact same amount of cash promised to you at some point in the future.
Right, because you can actually use that cash today. You can buy something, you can invest it, or you can just enjoy the security of having it in your pocket.
Exactly.
A promise of cash tomorrow doesn't pay for my groceries today.
It really doesn't.
So to look at the curriculum-specific example to ground this for you, if you have $9,500 today, and the market tells you that your $9,500 today is mathematically equivalent to $10,000 in exactly 1 year.
Well, that $500 difference is the compensation you are requiring just for waiting.
Right. That $500 represents a 5.26% rate on your initial $9,500.
Yes, it does.
But the text asks a really profound question right out of the gate here. What actually is that 5.26% rate? Like, what hat is it wearing?
It's profound because that single percentage point, that 5.26%, actually wears 3 distinctly different hats, depending entirely on your perspective in the transaction.
Okay.
The curriculum meticulously details 3 separate ways to interpret that exact same number. Let's walk through them.
Let's do it.
First, it can be viewed as the required rate of return. This is looking at it from the perspective of an investor who holds the power.
So it's the baseline.
Right. It is the absolute minimum percentage hurdle an investor will accept to willingly part with their money today.
If I'm the investor, I'm drawing a line in the sand and saying my time and my deferred consumption are worth exactly 5.26%.
Yes.
If the market comes to me and only offers a 4% return, what happens?
The investor simply folds their arms and keeps their cash.
The transaction never happened.
Never happens. The 5.26% is the threshold that triggers action. Now, the second interpretation flips the timeline completely.
Okay.
We can view that same 5.26% as a discount rate.
I always feel like discount rate is the term that makes people's eyes glaze over in finance meetings.
Oh, it totally does, but it shouldn't because it's essentially just a time machine.
A time machine. I like that.
The discount rate is the mathematical rate used to equate future cash flows back to their present-day value.
Right.
If you are standing in the present looking at a promise of $10,000 next year and you want to know what that promise is worth, right this exact second, you discount it backwards by 5.26% to arrive back at $9,500.
Which is exactly why finance professionals use interest rate and discount rate interchangeably in meetings. It's the exact same mathematical engine.
Exactly.
If you are standing at $9,500 and looking forward to the $10,000, it's an interest rate growing your money.
Yes.
But if you are standing at the future $10,000 and looking backward to today, it's a discount rate shrinking it down to present value.
The math doesn't change just the direction you're looking. It's a mere image.
Makes sense.
And that brings us to the third interpretation, which is perhaps the most rooted in behavioral economics. opportunity cost.
Okay.
This is the value of what you explicitly give up by choosing not to consume that $9,500 today.
Let me make sure I'm wrapping my head around the opportunity cost angle here. Let's say I don't invest in the 9,500.
Okay.
Let's say I take that cash walk down to a dealership and buy a used car today.
Right.
By doing that, I get the car, but the opportunity cost is that I am actively, consciously giving up that 5.26% growth. I am choosing the car over the $500 of future wealth.
Precisely. Every financial decision casts a shadow, and that shadow is the opportunity cost. If you choose to invest, the opportunity cost is the immediate enjoyment of the car.
Right.
If you choose the car, the opportunity cost is the 5.26% yield.
That sets the philosophical stage beautifully. We understand the concept of the rate. But let's get our hands dirty and look at the actual anatomy of that rate.
Let's do it.
Economics 101 tells us that interest rates are broadly set by macroeconomic supply and demand for money. But from an investor's perspective, the curriculum breaks down a market-determined interest rate into a very specific 5-part determinants equation.
It's like a recipe.
Exactly.
Yes, the anatomy of an interest rate. I want you to visualize an interest rate not as a single solid block, but as a stack of building blocks.
Okay, stacking blocks.
An interest rate is composed of a foundational, real risk-free rate plus a stack of 4 distinct premiums that specifically compensate the investor for bearing distinct types of economic risk. The full equation is interest rate equals the real risk-free rate plus an inflation premium plus a default risk premium plus a liquidity premium plus a maturity premium.
Okay, let's dissect that stack block by block for you listening. The very bottom block is the real risk-free rate. Now, this is a purely theoretical construct, right?
Yes, it is.
It assumes a magical world with absolutely zero inflation and absolutely zero risk of anyone defaulting.
Correct. It is the purest distillation of the time value of money. It represents pure time preference, just the psychological cost of delaying your consumption in a perfectly sterile, risk-free environment.
Well, we don't live in a perfectly sterile environment.
We definitely do not.
We live in a world where a cup of coffee costs more today than it did 5 years ago, so we have to add the second block, the inflation premium.
Right.
This compensates the investor for the expected loss of purchasing power over the life of the investment. If I lock my money up for a year and inflation is running at 3%, my money buys 3% less stuff when I get it back.
Yes.
I demand to be compensated for that structural erosion.
Exactly. And this leads to a crucial terminology distinction for the listener.
Right.
When you combine just those first 2 blocks, the pure, real risk-free rate plus the inflation premium, you get what is called the nominal risk-free rate.
Nominal meaning in name only or the stated rate before we worry about the messy real-world risks.
Right. In the real world, how do we actually find a proxy for this nominal risk-free rate? We can't just point to a theoretical concept.
Little number.
The curriculum cites very specific real-world instruments, short-term government debt, specifically things like the 90-day U.S. Treasury bill, or for a European context, French BTFs, which are negotiable fixed-rate discount Treasury bills.
Okay.
These serve as our best real-world proxies for the nominal risk-free rate over their respective very short time horizons.
Now, why specifically 90-day government debt? Why not, say, a 10-year bond?
Because we make a highly educated assumption that sovereign governments like the U.S. or France, which control their own printing presses, will not default on their obligations in a window as short as 90 days.
Ah, I see.
Furthermore, the 90-day window is so brief that the risk of massive unexpected interest rate shocks, which affect longer maturities, is essentially neutralized.
Makes sense.
So default risk, liquidity risk, and maturity risk are treated as practically zero. All you are left with is the real risk-free rate plus the inflation premium.
Okay, so that's our baseline. But the moment you move your money away from lending it to the U.S. government for 3 months, and you decide to lend it to a corporation or a local municipality, or you lend it for 30 years instead of 90 days, you have to start piling on the other 3 risk premiums.
You absolutely do.
Let's define those quickly before we play with them. Default risk premium is exactly what it sounds like. What if the borrower goes bankrupt and stiffs me?
Right.
Liquidity premium. What if I suddenly need cash and want to sell this bond, but the market for it is totally frozen, nobody is trading it, and I have to slash the price just to find a buyer?
You need to be paid extra upfront to take on that illiquidity trap.
Exactly. And finally, the maturity premium.
The maturity premium is tied directly to time. The longer a debt instrument is outstanding, the more sensitive its market price becomes to general fluctuations in global interest rates.
Okay.
If you hold a 30-year bond paying 3% and suddenly global rates spike to 6%, your 3% bond is deeply unattractive and its market value will plummet.
Nobody wants the 3% when they can get 6%.
Exactly. Holding all else equal, a longer maturity inherently means higher price volatility risk, and therefore the market demands a higher premium to hold it.
Let's make this highly practical for you listening. We're going to do a little financial forensics right now.
Oh, I like that.
I'm going to throw out the investment 1 versus investment 2 interactive scenario straight from the curriculum. And let's see if we can isolate these invisible premiums just by looking at the surface level yields.
Let's do it.
Imagine 2 debt securities out in the market. Investment 1 has a 2-year maturity, it has very low default risk, and it trades constantly, so it has high liquidity. Its quoted interest rate is 2.0%. Now, investment 2 is almost identical. It also has a 2-year maturity, and it also has low default risk. But it is highly obscure and rarely trades, meaning it has very low liquidity. Its interest rate is 2.5%.
What's fascinating here is how mathematically precise the market is in pricing these risks.
Yes.
As an analyst, you look at this and say, the time horizon is exactly the same 2 years. The credit quality is exactly the same, low default risk.
Right.
The inflation expectations over those 2 years are the same. So why is investment 2 yielding 0.5% more?
Because that 0.5% difference is exactly the liquidity premium.
Yes. The market is standing firm and demanding an extra 0.5% in yield every single year, strictly to compensate for the headache and risk that investment 2 cannot be quickly and easily converted to cash at its fair value.
It's amazing how you can just back out the math like that.
Yeah.
Okay, let's take it a step further and isolate the default risk premium. Let's look at investment 4 and investment 5 from that same curriculum example.
Right.
Both of these are longer term. They both have an 8-year maturity. Investment 4 has high liquidity and low default risk yielding 4.0%.
Got it.
Investment 5 is the messy one. It has low liquidity, and it has high default risk yielding 6.5%. How on earth do we find the specific default premium for investment 5 when it has 2 different variables dragging it down?
This is exactly why we isolated the liquidity premium in the first step. We have to adjust for the known variables first. Let's look at the total difference in yield between investment 4 and 5.
Yeah.
It's 2.5%, right?
Yeah, 6.5% minus 4.0%.
But we can't just say the default premium is 2.5% because we know investment 5 also suffers from low liquidity.
Right, and we already established from the first comparison that the market's going rate for suffering through low liquidity is a 0.5% premium.
Exactly. Assuming that liquidity penalty holds constant, we simply subtract that known 0.5% liquidity premium from the 2.5% total spread.
Okay.
What does that leave us with? Exactly 2.0%. Because maturity is identical and we've accounted for liquidity, the remaining 2.0% can only be one thing, the default risk premium. It is the exact quantified compensation investors are demanding for taking on the higher probability that the issuer of investment 5 will fail to make their payments.
I love that. You just peel back the layers of the yield one by one to see exactly what specific risks you are getting paid to stomach. That covers the foundational building blocks of rates. We know how the market prices the waiting game.
We do.
But as an investor, my ultimate question isn't just about the theoretical rate. It's about what actually ends up in my account. How are we measuring the return on these assets?
That brings us to Section 2, Rates of Return, which the curriculum positions conceptually as the dual engines of growth.
I like the term dual engines because financial assets typically generate wealth for an investor through 2 totally distinct mechanisms.
They do.
The first engine is periodic income. If you own a stock, this might be a quarterly cash dividend paid out from the company's profits. You own a bond, this is the semi-annual interest payment or coupon.
It is cash physically deposited into your account while you hold the asset.
Right. The second engine is capital gains or capital losses, which is simply the market price of the asset going up or down.
And different assets rely on different engines. If you buy a massive established utility stock, you might be getting a fat 5% dividend yield every year, but the stock price barely moves.
That's an income-heavy engine.
Yes. But if you buy a hyper-growth tech startup that reinvests every penny and pays 0 dividends, you are relying entirely on the capital gains engine. You only make money if the stock price goes up.
But to measure how these dual engines perform in tandem over a specific window of time, we use a concept called the holding period return, or HPR.
Conceptually, the holding period return is incredibly intuitive. You are simply asking, how much total value did I gain or lose from all sources divided by the exact amount of money I put on the line to begin with?
Keep it simple.
Instead of reading the dry formula, think of it this way. You take the price you sold it for, subtract the price you bought it for.
That gives you your capital gain or loss.
Then you add any cash income you received along the way, like dividends. You take that total final profit or loss figure and divide it by your original purchase price.
Let's walk through this specific mathematical example from the curriculum so you listening can really visualize it. Imagine a scenario.
Okay.
Let's say you buy 100 shares of the stock and you pay $34.50 per share at the beginning of the quarter.
So your total initial investment out of pocket is $3,450.
Exactly. Over the course of the next 3 months, the company pays you a total cash dividend of $51.55.
Nice little income stream.
Yeah, but the market has a rough quarter, the stock price drops, and you panic and sell all 100 shares at the end of the quarter for $30.50 each.
Ouch.
Your total proceeds from the sale are $3,050.
Let's calculate the holding period return for this scenario. We start by determining the capital gain or loss. Your ending value from the sale is $3,050. Subtract your beginning investment value of $3,450. This results in a capital loss of exactly negative $400.
The price engine totally failed us.
It did, but we still have the income engine. We add back the income you received, which was the $51.55 dividend.
Okay.
Negative 400 plus positive 51.55 leaves you with a total net loss across the entire investment of negative $348.45.
Still a loss.
To find the percentage return, we divide that total net loss by your initial $3,450 investment. The result is a holding period return of negative 10.1%.
The dividend was essentially a Band-Aid on a billet wound. Your dividend yield was about 1.5%, but your capital loss was a massive 11.6%. Net result, you were down 10.1% for the quarter. Now, that math is very straightforward for a single period. But what if we were looking at a much longer horizon? Say we held the investment for 3 years, and we have the individual annual return for year 1, year 2, and year 3. If I want to know my total holding period return across all 3 years, can I just take those 3 percentages and add them up?
Absolutely not. And if you take nothing else from this entire deep dive, please remember this rule. You cannot simply add sequential returns together. You must compound them.
You have to compound.
Instead of a linear addition, I want you to think of compounding like a snowball rolling down a hill.
I love this analogy. Break it down.
When a snowball rolls down a hill, it picks up new snow. But as it continues to roll, the new snow it just picked up also starts picking up its own snow. The surface area is constantly expanding.
Right.
In finance, you aren't just earning returns on your original deposit, you are earning returns on the returns you made yesterday. So mathematically, you aren't adding the percentages, you are multiplying the new total size of the snowball at each step.
So the formula for a multi-period HPR isn't R1 plus R2. It's taking the number 1, adding the first period's return to it to represent your new total wealth multiplier, and multiplying that by 1 plus the next period's return.
Yeah.
So 1 plus R1 multiplied by 1 plus R2 multiplied by 1 plus R3, and then you subtract the original 1 at the end to isolate just the growth.
Exactly. If you make 10% in year 1 and 10% in year 2, you didn't make 20% total. You multiply 1.0 by 1.20, which equals 1.21. Subtract the 1 and your actual return is 21%.
That extra 1% is the new snow picking up snow.
It's the return you earned in year 2 on the profits you made in year 1.
Which perfectly sets us up for Section 3, and honestly my favorite part of this entire module, the battle of the means.
It is a good one.
We are looking at 3 fundamentally different ways to calculate average returns: arithmetic, geometric, and harmonic. Because it feels like Wall Street uses whichever average makes their performance look the best on a marketing brochure rather than what's actually true.
That is a very astute observation, and it is exactly why the CFA curriculum emphasizes understanding the flaws of each method. Let's start with the most common, the most intuitive, and frankly the most deceptive method when applied to multi-period returns, the arithmetic mean.
The arithmetic mean is just what we all learned in grade school. It's a simple average. You add up the numbers, and you divide by how many numbers there are. How bad can a simple average really be?
It can be catastrophic if you rely on it to understand your compounding wealth. The fundamental flaw of the arithmetic mean in finance is that it assumes the amount of money invested at the beginning of every single period is exactly the same.
Oh, I see.
It completely ignores the reality of the snowball we just discussed. It ignores compounding entirely.
Let's look at the curriculum's trap to prove this. This is a brilliant example. Let's say you invest in a volatile mutual fund for 3 years. In year 1, the market crashes and your investment drops by 50%. A terrible year.
Very bad.
But in year 2, the manager bounces back and the fund gains 35%. In year 3, the hot streak continues and the fund gains 27%. If the manager calculates the arithmetic mean to put on their marketing flyer, they add -50, +35, and +27. That sums up to a +12. They divide that by 3 years, and they proudly report an average annual return of +4%. Sounds great, right? About 4% a year.
It sounds great until you look at your bank statement.
Yeah.
Let's trace the actual euros in the account. Let's say you start with exactly €1. A 50% drop in year 1 doesn't just mean a bad percentage, it means half your wealth is physically gone. You are left with €0.50.
Right.
Now, in year 2, the fund gains 35%. But here's the critical catch. That 35% gain is calculated on your new decimated balance of €0.50, not on your original €1.
Oh, right.
So 35% of €0.50 is only €0.175. Add that back, and your ending balance for year 2 is €0.675.
Okay, I'm starting to see the problem here. Even though I had a huge 35% up here, I'm still deeply underwater from the first year's crash.
Exactly. The gravity of a loss is immense. Now, in year 3, the fund gains a solid 27%. But again, that 27% is only multiplying against the €0.675 you currently hold. 1.27 times €0.675 brings your final ending balance at the end of year 3 to €0.8574.
This sounds exactly like the kind of math my broker uses to tell me I'm having a great year right before I look at my empty bank account.
It really does.
I started with €1, and after 3 years of an average 4% gain, I ended up with about 86 cents. I physically lost over 14% of my total wealth. This feels almost criminal. Why does the arithmetic average get it so dangerously wrong?
Because it ignores the asymmetrical nature of percentages. If you lose 50% of your money, you don't need a 50% gain to get back to even. You need a 100% gain.
Right.
If you have $1 and lose 50 cents, a 50% gain on that remaining 50 cents only gets you to 75 cents. You are still down. The arithmetic mean treats a plus 50% and a minus 50% as perfectly canceling each other out to 0.
But they don't.
But in reality, mathematically, a 50% loss followed by a 50% gain leaves you down 25%. This bias in the arithmetic mean becomes incredibly severe when your returns are highly volatile and swinging wildly between positive and negative numbers.
So the takeaway for the listener is never ever use the arithmetic mean to evaluate historical portfolio performance over multiple years. It will lie to you. But here's where it gets really interesting. We have a truth teller in the curriculum, the geometric mean.
Yes, the geometric mean is the antidote to the arithmetic mean's deception. It calculates the true compound rate of growth. Think of the geometric mean as answering one very specific question.
Okay.
If my portfolio had grown at one flat, perfectly smooth rate every single year with no volatility, what would that rate have to be to hit my exact ending balance?
I love that framing. It smooths out the chaotic roller coaster of plus 35% and minus 50% into a single honest number. Without reading the messy formula aloud, the math essentially involves multiplying all your return multipliers together, the snowball, and then taking the nth root of that final number where n is the number of years.
Let's apply that to the exact same numbers that lied to us before. The returns were negative 50%, positive 35%, and positive 27%. So we convert those to our multipliers, 0.50, 1.35, and 1.27.
Okay.
We multiply those three together, and because it's a 3-year period, we take the cube root of that product, then we subtract 1. When you run that math, the geometric mean equals exactly negative 5%.
And suddenly the universe makes sense again. The arithmetic mean said we were making a positive 4%, but the geometric mean says we were compounding at negative 5%.
And that negative 5% tells the absolute truth. If you take your original €1 investment and you let it compound at exactly negative 5% for 3 years, meaning it drops 5% in year 1, then drops another 5% in year 2, then another 5% in year 3, it would equal exactly €0.8574.
Which matches the actual real-world ending balance perfectly.
Perfectly. The key takeaway, the absolute rule of thumb for you listening is this. The geometric mean will always be less than or equal to the arithmetic mean.
Is there ever a scenario where they are exactly the same?
The only time they are ever exactly equal is if the returns for every single period are completely identical. If you make exactly 10% every single year, both means are 10%.
Right.
But the moment you introduce even a tiny bit of volatility, say a 9% year and an 11% year, the geometric mean drops below the arithmetic mean. The more extreme the volatility, the wider that gap becomes. Arithmetic is for simple, single-period statistical estimates. Geometric is for measuring historical compounding reality.
Okay, so arithmetic is the deceptive villain. Geometric is the truth-telling hero. What about the third sibling, the harmonic mean? It feels like the hyper-specialists of the group. What is it actually good for?
The harmonic mean is a specialist. It is specifically designed for situations where you are averaging ratios or amounts per unit, particularly when those ratios are repeatedly applied to a fixed quantity.
Okay.
In finance, its absolute most famous application is averaging price to earnings or PE ratios across a portfolio of stocks or calculating average costs in dollar cost averaging strategies.
I know the math formula for this one is a bit of a nightmare to look at. It involves taking the reciprocal of the arithmetic average of the reciprocals of the data points, which sounds like a riddle.
It really does.
But let's look at the PE ratio example because that makes it tangible. Say you are building a small portfolio and you buy equal dollar amounts of 3 different stocks. You look up their PE ratios. Stock A trades at a massive 45 times earnings. Stock B trades at 15 times earnings. Stock C trades at 15 times earnings.
Okay.
If you are lazy and just take the simple arithmetic mean 45 plus 15 is 75, divide by 3, and you say your portfolio has an average PE at 25.
But using the arithmetic mean for ratios mathematically skews the result toward the highest numbers. It gives disproportionate weight to that massive 45 PE ratio.
Right.
The harmonic mean corrects this bias because the harmonic mean uses reciprocals, essentially flipping the numbers upside down before averaging them. It naturally gives far less weight to massive outliers.
So when you run the harmonic mean math on those same 3 numbers, 3 divided by the sum of 1 over 45 plus 1 over 15 plus 1 over 15, the result isn't 25. The result is 19.3.
Exactly. 19.3 is a much lower number, and critically, it is a much more statistically representative average of the portfolio's true aggregate valuation multiple. If you bought equal dollar amounts of those companies, your actual blended PE ratio is 19.3, not 25.
And there's a mathematical hierarchy here that is a classic exam question, so listeners write this down. For any set of varied non-identical returns, the harmonic mean is strictly less than the geometric mean, which is strictly less than the arithmetic mean. Harmonic is always the lowest.
Always.
Before we leave the topic of averages, the text briefly mentions handling dirty data. What happens when your data set just has bizarre extreme outliers that break all these averages? Say a penny stock that went up 10,000% because of a typo on an exchange.
Dealing with extreme outliers is a common quantitative headache. The curriculum highlights 2 statistical tools for cleaning this data. The first is the trimmed mean. This is exactly what it sounds like. You simply chop off a certain percentage of extreme values from both the very top and the very bottom of your data set before you calculate the average. If you use a 5% trimmed mean, you delete the top 2.5% highest returns and the bottom 2.5% lowest returns and average what's left in the middle.
So you just throw the crazy data in the trash. What's the second tool?
The second is the Windsorized mean. Here, instead of dropping the extreme values entirely and shrinking your sample size, you replace them. You cap them at the value of the nearest percentile you're keeping.
Oh, interesting.
For instance, if you are calculating a 90% Windsorized mean, any return that falls in the top 5% is simply overwritten and replaced by the exact value of the 95th percentile return. Any return in the bottom 5% is overwritten by the value of the 5th percentile return.
Both techniques prevent one single insane outlier from dragging your portfolio average around, giving you a much better picture of the central tendency. Which brings us perfectly to Section 4, Tracking the Cash. We're going to tackle money-weighted returns versus time-weighted returns. And I want to set up the core real-world conflict here, because this is a drama that plays out in wealth management offices every single day.
It definitely does.
Imagine you have a mutual fund manager. Let's call her Sarah. Sarah is a genius. She is picking great stocks, navigating the macro environment perfectly. But Sarah has a problem for retail clients.
Ah, yes.
Her clients keep panic selling and withdrawing all their cash right at the bottom of the market when things look scary, and then they get FOMO and dump huge piles of cash into her fund right at the absolute top of the market.
Classic behavior.
Sarah's overall fund size is fluctuating wildly based on the emotional behavior of her clients. How on earth do we fairly judge Sarah's actual skill as an investor versus the client's actual experience in their wallet?
You have just described the ultimate performance measurement dilemma in finance. The manager controls the assets, but the client controls the cash flows.
Yeah.
And the curriculum gives us 2 distinct, highly specialized tools to solve this dilemma. Let's start by looking at the outcome from the perspective of the client's wallet. To measure the investor's specific experience, we use the money-weighted return, or MWR.
Why is it called money-weighted?
Because the weight of the money, how much capital is actively deployed during any given period, is the driving factor. Mathematically, the MWR is exactly equivalent to calculating the internal rate of return, or IRR. It cares deeply about the exact calendar timing and the exact dollar amount of every single cash deposit and withdrawal.
Let's walk through an agonizingly clear example. Let's create a hypothetical investor. Let's call him Panicky Pete.
Okay, Panicky Pete.
Pete puts 100 euros into Sarah's mutual fund at the start of year one. During year one, a global crisis hits. The fund has a terrible year and drops 50%. Pete's 100 euro balance is now pulverized down to 50 euros.
So far, this is just a straightforward bad investment. Pete has experienced a 50% loss.
But then, at the start of year two, Pete reads an article saying a bull market is coming. He decides to double down. He takes 950 euros out of his savings and dumps it into the fund.
Wow.
His new balance is exactly 1,000 euros. He timed it perfectly. Sarah, the manager, goes on an absolute tear. The fund shoots up 35% in year two. Pete's 1,000 euros becomes 1,350 euros.
Nice.
Feeling rich, Pete withdraws 350 euros at the end of year two to buy a watch, leaving a clean 1,000 euros in the account. In year three, Sarah's hot streak continues. The fund goes up another 27%. Pete's final balance is 12,270 euros. So the question is, what is Pete's actual return?
To answer that, we have to look at the two separate realities. If you look purely at Sarah's fund, the underlying periodic returns were negative 50%, positive 35%, and positive 27%. We already established in our previous segment that the true geometric compound return of the fund itself across those 3 years was a negative 5%.
Right. If you just left 1 euro in there and never touched it, you lost 5% a year. But Pete didn't do that.
Exactly. Pete's personal experience was vastly different and largely positive. Why? Because during the terrible negative 50% year, he only had a tiny amount of money exposed, just 100 euros. He only lost 50 euros.
Right.
But during the great 35% and 27% years, he had a massive amount of capital, 1,000 euros actively compounding. The positive percentages were multiplying against a much larger base. When you use financial software to set the present value of Pete's specific cash inflows and outflows to zero, and you solve for the internal rate of return, Pete's personal money-weighted return is a massive 26.11%.
A 26% return for Pete in a fund that mathematically lost 5% over the same time frame. That is wild.
It highlights the extreme power of cash flow timing. The MWR captures reality for the wallet. It is the absolute perfect metric for measuring what the investor actually achieved. It holds the investor accountable for their timing decisions.
But does it tell us if Sarah, the fund manager, is actually good at her job?
If we connect this to the bigger picture of institutional finance, the answer is a resounding no. How could we possibly evaluate Sarah's stock-picking skill using Pete's 26% return when Sarah had absolutely zero control over the fact that Pete randomly decided to dump 950 euros into the fund right before a bull run?
She couldn't.
If Pete had dumped that money in right before the 50% crash, his MWR would be disastrously negative, and Sarah would look like the worst manager in history, even though her stock picks were exactly the same.
So to judge the manager fairly, we must neutralize the effect of the cash flows. We need a metric that removes Panicky Pete from the equation entirely. And that is where we introduce the time-weighted return, or TWR.
Yes. TWR is the undisputed gold standard for performance evaluation in the global investment industry. In fact, under the Global Investment Performance Standards, or GIPS, firms are generally required to present time-weighted returns precisely because it isolates manager skill from client behavior.
The curriculum outlines a very strict 3-step process to calculate TWR, and it's basically designed to break the timeline whenever cash moves. Step 1. You must value the entire portfolio immediately prior to any significant cash flow entering or exiting. This effectively breaks the overall evaluation period into smaller, independent subperiods.
Step 2. You calculate the simple holding period return for each of those separate subperiods.
And step 3. You geometrically link or compound those subperiod returns together to get the final pure time-weighted return.
Let's illustrate that 3-step process with the Wallbright Fund example from the text. The fund starts the year with $100 million in assets. Over the first 4 months of the year, Sarah makes some trades, gets some dividends, and the portfolio grows. But then on May 1st, a new client wants to deposit $10 million.
Stop the clock. Step 1 triggers. We have to value the portfolio right before that new $10 million hits the account.
Exactly. We value the portfolio on April 30th. Let's say we calculate that the holding period return for that initial 4-month subperiod, completely untainted by the new cash, was 6.28%.
Then the new $10 million comes in. The portfolio is rebased at a higher total value. The clock restarts. Over the remaining 8 months of the year, Sarah keeps managing the newly enlarged pool of money, and she generates another holding period return of 8.06% for that specific 8-month window. We now have two separate returns. How do we combine them for the annual report?
We proceed to step 3, geometrically link them. We take 1 plus 0.0628 and multiply it by 1 plus 0.0806 and then subtract 1. The mathematical result is a time-weighted return of 21.03% for the full year.
And that 21.03% is the pure, unadulterated measure of Sarah's compounding skill over the year. It is totally unaffected by the fact that the fund got larger in May. It just strings her percentages together.
Exactly.
Now, it is worth noting the text points out that because the Walbright Fund actually had more total money invested during the second slightly lower performing 8-month period, the money-weighted return for the fund as a whole was slightly lower at 20.05%. The larger pile of money experienced a slightly lower growth rate, dragging down the MWR.
That slight divergence is completely normal. The crucial rule of thumb to remember is this. If a fund manager achieves their highest returns during periods when the fund has the most capital invested, the money-weighted return will be higher than the time-weighted return. Conversely, if they achieve their best returns when the fund is small and their worst returns when the fund is large, the MWR will be lower than the TWR.
So the key takeaway for our listeners prepping for the exam: time-weighted measures the manager's brain. Money-weighted measures the investor's timing. Burn that distinction into your memory. Let's transition to Section 5, apples to apples. We're talking about annualizing and continuous compounding.
A very important section.
It's great to have a return percentage, but the financial world is messy. How do we compare the performance of a short-term 15-day trade to a massive 3-year private equity lockup? We have to translate them into the same language. We have to annualize them to a common 1-year baseline.
Yes, standardization is key. The formula for annualizing a return for a period shorter or longer than a year is mathematically straightforward. You take 1 plus the period of return, raise it to the power of c, and then subtract 1.
And what does C represent?
C is simply the number of those specific periods that fit into a single calendar year. If you have a monthly return, C is 12 because there are 12 months in a year. If you have a weekly return, C is 52.
Right. The curriculum gives a great micro example. You make a quick trade, and over 15 days, you generate a return of 0.4%. Not bad for 2 weeks. But to compare that to an annual bond yield, you need to annualize it. Assuming a standard 365-day year C would be 365 divided by 15.
Okay.
So you take 1.004, raise it to the power of 365 over 15, which is roughly 24.33, then subtract 1. When the dust settles on that calculation, your tiny 0.4% return mathematically scales up to a very impressive annualized return of 10.21%. You can now take that 10.20% and benchmark it against the S&P 500 or Treasury yield.
Mathematically, yes, you can do that. But as an analyst, you have to be incredibly careful here. There is a massive blinking warning light attached to this calculation.
Why? The math is sound.
The math is sound, but the assumption underlying the math is incredibly dangerous. Annualizing relies on the heroic assumption that you can repeat that exact same performance over and over and over again, continually reinvesting your capital and your profits at that exact same rate for the rest of the year.
Oh, I see.
The text gives a stark example to illustrate the absurdity of this. Imagine you get lucky and a stock you buy jumps 5% in a single week.
A great week.
A fantastic week. But if you blindly plug that into a spreadsheet and annualize that 1-week return, meaning you take 1.05 and raise it to the 52nd power, assuming 52 weeks in a year, you get an annualized return of 1,164%.
Which implies that I could take a $1,000 paycheck and turn it into almost $13,000 by Christmas just by day trading.
Exactly. It assumes you possess the supernatural ability to consistently find a guaranteed 5% return every single week for an entire year without ever taking a loss and compounding your ever-growing pile of cash seamlessly. In reality, that is statistically impossible.
Yeah, definitely.
So while you can mathematically annualize very short-term, highly volatile returns, doing so creates ridiculous, unusable fantasy numbers.
Right.
You have to use professional common sense. Never annualize a highly volatile short-term pop.
Okay, consider me warned. But let's look at the flip side. What about when compounding happens more frequently than just once a year, but it's guaranteed? Like a high-yield savings account that explicitly pays you interest every single month or even daily.
That's different.
We have to adjust our standard present value formula to account for the fact that the snowball is picking up snow much faster. The adjusted formula becomes present value, or PV, equals future value, or FV, divided by the quantity of 1 plus the stated annual rate divided by M, all raised to the power of M times N.
It sounds like alphabet soup, but the variables are simple. M is simply the number of compounding periods in a single year. If it's monthly, compounding M is 12. If it's daily, M is 365, and remains the total number of years.
The curriculum provides a very grounded scenario here.
Mm.
A Canadian pension fund manager is running a liability matching strategy. She knows for an absolute fact that she needs exactly 5 million Canadian dollars to pay out retirees in exactly 10 years.
Okay.
She finds a guaranteed investment contract from a bank that pays a stated annual rate of 6%, but critically, it compounds monthly. How much must she wire to the bank today to guarantee she hits that 5 million target? Let's walk through the logic.
We start by breaking down the rate. The stated annual rate R is 0.06, but the bank pays monthly, so M is 12. We divide the annual rate by the compounding periods. 0.06 divided by 12 equals 0.005. That means the fund is actually earning a discrete 0.5% return every single month.
Okay, what about the timeline?
The total time horizon is 10 years, which is N. But since the snowball rolls monthly, we multiply 10 years by 12 months to find the total number of compounding periods. That gives us 120 distinct periods where interest is calculated and added to the pile.
So we take our 5 million target and we divide it by 1.005 raised to the 120th power. The calculator spits out $2,748,163.67.
Yes.
If she invests that exact amount today, the monthly compounding engine will grind away for a decade and deliver exactly $5 million on the deadline.
Precisely. That covers discrete compounding situations where interest is calculated at specific discrete intervals, whether that's monthly, daily, or even hourly. But theoretical finance loves to push boundaries.
They always do.
What happens if you push the variable m to infinity? What if compounding doesn't happen every day or every second, but continuously in a seamless, unbroken flow? This is where we encounter continuous compounding.
Okay. My understanding of continuous compounding is that if I ask a bank to continuously compound my interest, the discrete math formulas we just used literally break down. They give you a division by infinity error.
Right.
So we have to abandon standard algebra and use the natural logarithm to note it on a calculator as ln. The formula for calculating a continuously compounded rate of return is incredibly elegant. R equals the natural log of the ending price divided by the beginning price.
Right.
Basically, ln of P1 over P0.
Let's apply it to a real number so it's not abstract.
Right.
Think back to our earlier example of the stock that you bought at $30 and it went up to $34.50. We calculated that the standard discrete holding period return was a clean 15%.
Right.
But what if we want to express that exact same price movement as a continuously compounded return? We take the natural log of the price relative, which is the natural log of 34.50 divided by 30, or the natural log of 1.15. When you hit the ln button on that, the result is 13.98%.
Wait, I noticed something immediately. 13.98% is a smaller number than the 15% discrete return we calculated earlier. Why is the continuously compounded rate lower?
Because of the efficiency of the compounding engine. Continuous compounding assumes that every microscopic fraction of a penny of interest you earn instantly begins earning its own interest a millisecond later.
Okay.
Because the snowball is growing infinitely fast, you actually need a slightly lower stated interest rate, 13.98%, to reach the exact same final dollar destination, $34.50, than you would if you only compounded once at the end of the year, 15%.
Okay, I understand the mechanics of it, but I have a practical question. Why do we bother? No bank account in the world actually pays interest continuously every microsecond. Why do quantitative analysts and financial engineers love the natural log so much? Why is it a foundational concept for advanced models like the Black-Scholes options pricing model?
They love it because of one magical mathematical property. Continuously compounded returns are perfectly additive over time.
Expand on that. Additive in what way?
Remember earlier when I was adamant that you absolutely cannot add multi-period discrete returns? I said you must never do R1 plus R2. You have to do the complicated 1 plus R1 times 1 plus R2 minus 1 snowball math.
Yes, I remember.
Well, with continuously compounded returns, you actually can just add them. The continuous return from year 0 to year 5 is exactly mathematically equal to the continuous return of year 1 plus year 2 plus year 3 plus year 4 plus year 5. You just sum them up.
Oh, wow. So R sub 0 to t literally equals R sub t minus 1 to t plus all the way down.
Yes. That additive property is an absolute superpower for quants. When you are a financial engineer running massive Monte Carlo simulations with tens of thousands of random volatile variables trying to geometrically multiply thousands of probability distributions together is a computational nightmare. It breaks models.
Too much math.
Exactly. But adding normal distributions together is mathematically straightforward and elegant. Continuous compounding transforms complex, clunky multiplication into simple addition, making advanced stochastic calculus and quantitative modeling actually functional in the real world.
It's a mathematical cheat code for Wall Street. I love that. So we've talked a lot about theoretical returns. We've lived in the land of pure math and frictionless environments. Let's ground this deep dive in Section 6, the real world. We have to deal with the villains that actually eat away at your wealth fees, taxes, inflation, and the double-edged sword of leverage. First up, gross return versus net return.
This is the most basic yet most important distinction when reading a mutual fund prospectus. Gross return is designed to measure the pure investment skill of the manager. It is the return generated by the portfolio after deducting direct trading expenses like the commissions paid to brokers to physically buy and sell the stocks. But critically, it is measured before deducting any management fees or administrative costs.
Right.
Gross return shows what the raw portfolio itself actually yielded. Net return, on the other hand, is a gross return minus those managerial and administrative fees.
In simple terms, gross return is what the manager brags about at cocktail parties. Net return is what you actually get to keep in your pocket. If a hedge fund reports a stellar gross return of 10%, but they charge a classic 2 and 20 fee structure, meaning a 2% flat management fee, the net return to you, the investor, is roughly 8%. When you are evaluating a manager's skill against a benchmark index like the S&P 500, you should usually look at their gross return because indexes don't have management fees. But when you are evaluating what goes into your retirement account to pay for your life, you only care about the net return.
Exactly. Net return is the reality of the business model. And speaking of reality, we must confront reality check number 2, taxes. Pre-tax versus after-tax nominal return.
Up to this exact moment in the deep dive, every single formula we've discussed assumes pre-tax nominal returns. We've pretended the IRS doesn't exist. But in the real world, the government always takes a cut.
They certainly do. And the complication is that different types of investment income face entirely different tax brackets depending on your local jurisdiction. For example, if you actively day trade and flip a stock for a profit in 3 weeks, that is a short-term capital gain, and it is usually taxed at your highest ordinary income tax rate. It's treated like a paycheck.
Yeah, that hurts.
But if you hold that same stock for over a year, or if you receive qualified dividends, those often get preferential much lower tax rates to incentivize long-term investing. The after-tax nominal return is your ultimate bottom line. It calculates exactly how much your wealth grew after the government took its legally mandated slice, but before we account for the final villain, inflation.
Which is reality check number 3. And inflation might be the most insidious villain of all because it's invisible. A 10% after-tax return sounds phenomenal on paper. But if you live in an economy where hyperinflation is running at 12%, you didn't actually make money. You lost purchasing power. Your pile of money is numerically larger, but it buys fewer groceries than it did last year. To fight the illusion of inflation, we have to calculate real returns.
The relationship between nominal returns, the stated percentage, and real returns, your actual purchasing power, is multiplicative, not additive. The formula states that 1 plus the real return equals 1 plus the nominal return divided by 1 plus the inflation rate. Or more simply, 1 plus real equals 1 plus nominal divided by 1 plus inflation.
Let's use the curriculum's data to put numbers to this. Historically, over long periods, equities might yield an 8% nominal return. If inflation over that exact same historical period is running at an average of 2.1%, what is the true real increase in an investor's purchasing power? We don't just subtract 2.1 from 8. We divide 1.08 by 1.021 and then subtract 1. The real return is exactly 5.8%.
That 5.8% is the true measure of wealth creation. Real returns are the only mathematically valid way to compare investment performance across different historical decades, say the hyperinflationary 1970s versus the low inflation 2010s, or across different countries with vastly different central bank policies. You must strip out the distortion of the currency itself.
Okay, we have arrived at the final real-world factor in our module leverage, using borrowed money to juice your returns. It is a massive component of how the modern financial system operates, from retail real estate investors buying rental homes to hedge funds to massive private equity buyouts.
It's everywhere.
The formula provided in the curriculum for calculating a leveraged return looks a bit daunting on the chalkboard. R sub L equals the portfolio return multiplied by total assets minus the total cost of debt, all divided by your initial equity. But rather than stare at the algebra, let's use an example to make the mechanics of leverage intuitive.
Let's build a scenario. Imagine you have a brilliant idea for a 10 million euro portfolio of assets. You scrounge up 7 million euros of your own personal equity, that is the variable V sub E. But you are 3 million short. So you go to a bank and borrow 3 million euros in debt. That's V sub B.
Yummy.
The bank isn't a charity, so they charge you an interest rate on that borrowed debt R sub D of exactly 5%. Over the course of the year, your thesis plays out, and the underlying assets in the portfolio earn a solid 8% return, so the portfolio return is 8%.
Let's calculate the total dollars flowing around here. You earned an 8% return on the entire 10 million euro asset base. 8% of 10 million means the assets physically generated 800,000 euros in gross gains. But before you can celebrate, you have to pay the bank.
Always.
You borrowed 3 million euros at 5% interest. 5% of 3 million is 150,000 euros in interest expense. You have to write that check. So you take your 800,000 in asset gains, subtract the 150,000 interest payment to the bank, and you are left with exactly 650,000 euros in pure net profit.
Now here is where the magic of leverage appears. To find your leveraged return percentage, you don't divide that 650,000 euro profit by the 10 million total portfolio size. You divide it by the actual amount of skin you personally put in the game, which was only your 7 million euro equity. 650,000 divided by 7,000 equals a leveraged return of 9.29%.
This is incredible. The underlying assets only grew by 8%. But because you used the bank's money to buy more assets than you could afford, your personal return on your equity got juiced up to 9.29%. It looks like absolute free money. You are arbitraging the difference between the 8% asset return and the 5% cost of debt.
It is the mechanism that has built massive fortunes. But I must issue a severe neon flashing warning here. Leverage is entirely asymmetrical in its psychology, even though the math is perfectly symmetrical. Leverage only works its magic if the portfolio return is strictly and consistently greater than the cost of debt.
What happens if the assets underperform? Let's say the portfolio only earned a 4% return instead of 8%.
If the portfolio earns 4% on 10 million, you generate 400,000 euros in gains. But you still owe the bank their 150,000 euros in interest. The bank does not care that you had a bad year. You write the check, leaving you with 250,000 euros. Divide that by your 7 million equity, and your return plummets to 3.5%.
Wow.
Your leveraged return is now worse than the underlying asset return. The cost of debt acted as an anchor dragging down your equity. Leverage is a double-edged sword. It amplifies losses exactly as ruthlessly and efficiently as it amplifies gains. If the portfolio drops by 10%, your equity gets wiped out at an accelerated rate because the debt value remains fixed.
A sobering but absolutely essential note to end our mathematical journey on. Leverage is financial fire. It can heat your home or it can burn it to the ground.
Well said.
We have covered an immense, truly staggering amount of ground today. I want to genuinely congratulate you, the listener, for making it through what is undeniably one of the most dense, mathematically rigorous deep dives we have ever done. But look at what we've accomplished. We started by dissecting the very DNA of interest rates, stripping down that time value of money to find the real inflation, liquidity default, and maturity premiums hiding inside.
We survived the battle of the means, realizing that the arithmetic average will lie to you while the geometric mean tells the truth about compounding.
We untangled the messy reality of Panicky Pete, proving that the time-weighted return measures the manager's brain while the money-weighted return measures the investor's timing. And finally, we survived the real-world gauntlet of fees, taxes, inflation, and the terrifying math of leverage.
It is a lot to absorb in one sitting. I encourage listeners to review these concepts because mastering these exact mechanics is the absolute foundation for the rest of your quantitative method study. Every single complex equity valuation model, every fixed income pricing formula you encounter later in the CFA curriculum builds directly on these core principles of time value and return measurement. If you master this, the rest becomes much easier.
And as promised at the beginning of the show, we don't just want to give you the answers, we want to provoke your thinking. We want to leave you with a final puzzle to mull over, something to test your newly forged analytical skills against a real-world edge case.
I think this is a perfect puzzle. It raises a fascinating question based directly on what we've learned today. We established earlier that the time-weighted return is the undisputed gold standard for evaluating public portfolio managers like Sarah, the mutual fund manager. And it's the gold standard precisely because Sarah cannot control when retail clients deposit or withdraw cash. She needs a metric that isolates her skill from their behavior. But consider the entirely different world of private equity or venture capital. In those illiquid spaces, the fund manager explicitly dictates the cash flows. The clients don't get to withdraw when they panic. The manager calls capital from investors exactly when they find a deal, and they distribute capital back only when they successfully sell a company. The manager is entirely in the driver's seat regarding the timing of the money.
Oh, that completely flips the premise of our mutual fund example.
Exactly. So
Right.
Here is your question to explore. In a financial ecosystem where the manager actually does control the exact timing of the cash flows, Does the time-weighted return lose its crown? And should the money-weighted return, the IRR, become the ultimate fairest judge of that private equity manager's skill?
That is a brilliant question that strikes right at the heart of how trillions of dollars in alternative assets are evaluated. Think about it. Argue it out in your head. Maybe debate it with a study partner. That brings us to the end of today's deep dive into the mathematical engines of finance. Thank you so much for sticking with us, for pushing through the formulas, and for diving deep. Keep questioning those assumptions, and best of luck on your continuing educational journey. We'll see you next time.